And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. So, I do not want to get into what's going on with this Hormuz, because I can tell you it's gotten to the point that it's affected the market so much that you really got to be watching your trends in these stocks. What I'm talking about is you got to be real conscious of the strength of each stock. And it's all about trend. And people will just trade a stock. They don't know what trend is. They don't know how yields is a compass for their stock. The yield is how can I guess the best way to put it is a compass. You know, it points you in the direction your stock is going to go. It never fails you. It always tells the truth. And you got to really start hanging on to that compass, and there's so many stocks right now in the tech sector that the risk is just crazy, okay? And you've got to make sure that when you buy a stock that you're trading risk off, and the yield will tell you if the stock you're in is risk off or risk on. And this is where a lot of people lose money. They don't understand that. They just hear something on CNBC or Fox Business. They're called FOMOs. They jump in it, just keep going. I don't want to miss out. The same thing with NVDA. You know, you got to watch the yields. And in every stock, as long as the stock continues to trade with the risk off, and you watch those yields, then you'll be fine. You won't get caught. If you remember, I think it was last Friday or the week before, I don't remember, where everybody got caught. Everybody was shorting tech stocks. Everybody was shorting the 4 big factory stocks that make the machines that make the chips. And people didn't realize Wall Street's in there telling them to dump, to sell those stocks, because they were trying to push Wall Street, and it's 6, let's say, big managers who manage all the money. There's only really 6 people that manage $62 trillion, of which $12 trillion goes to the stock market. They make all decisions, and when they want to push a stock, one of their stocks, up or down, they have an army, okay, of 65 million people, and they've always got 10 to 12 trillion they can push one way or the other. So many times they're pushing a stock, people are jumping in, and they don't realize that's a big risk on stock. If they only understand how to look at a yield, they would know, wait a minute, I want a stock that is risk off, not risk on. But people are so afraid of missing out, just like with NVIDIA here. They're so afraid of missing out, they don't look at anything. They just jump in head first. And they hear all the stories like how in the last 5 years, if you would have made a 960% return, okay, on NVIDIA. $1,000, you would have made $10,000. So that's what people hear. People jump in. They don't want to miss out. So you got to be very, very careful. I want to make sure I got that right. AMG is tanked. And AMG, by the way, if you knew how to short, And let me see if I can get my AMG up here for 1 second. Here's my AMG right here. Yeah. AMG was telling you that it was setting up for a good short position, and it's still setting up for even a better short position. And another thing about AMD, AMD loves yields that are going down. Okay, love yields that are going down. And when yields are going down, usually tech stocks like AMD, their other tech stocks will go up. And right now the trend is breaking on AMD, and they tank just 6%. AMD can go down much further because they can't catch up right now to NVIDIA. They're playing catch up. It's going to take them years to catch up to NVIDIA. So when you look at an opportunity, that's what you want to look at. Okay, is AMD. Qualcomm was another great opportunity. It was another great short. But again, and NVIDIA right now, you got to realize when a stock like NVIDIA pops, and don't jump in and what we call FOMO, fear of missing out. If you look at that stock, you got to wait, and you need to let that stock pull back. Let it pull back. So let's say right now it's at the high, let's say it's $221. Let it pull back. And then when it gets above that $221, then go in. But today, people are getting crushed. They're all jumping in right at the peak because they're the fear of missing out. And they're going to lose a lot of money. So as long as you know, let it pull back. Next time it rallies, as long as the yield is down, as long as the big institutions are pushing money into that stock, where you got a very, very nice trend, okay, what we call a money trend, then you're good to go. But I wouldn't be buying NVIDIA today. The time to have bought NVIDIA, okay, was the perfect time to have bought NVIDIA was back on July 17th. You had a perfect buy signal on July 17th. But people that are jumping in today, man, you got to be crazy. So AMD's tanking. AMD's going to be a good short story. We're going to see AMD really get hit hard, and I think that could be a great opportunity. Now, but is NVIDIA really sustainable? Okay, as long as AI keeps exploding, it is. Now everyone says, well, AI will always keep exploding. The demand's exploding. It will always explode. Well, it doesn't always work that way. We heard that back in the dot-com days too. Remember, not AI, but with a similar story. But there's always risk in a stock. And if you could just learn when you buy a stock that you're always buying that stock risk off, you just reduced your chance of losing money by 75%. By 75%. Remember, you got 65 million people. 95% of those people lose money every day. 85 to 95% lose money every day. That's crazy. That's nuts. Because, again, they don't understand risk on, risk off. And NVIDIA right now is not one of these safe, slow, steady stocks. You gotta, if you're going to be buying NVIDIA right now, and you're buy and hold, and you think you're going to put money in there, you're going to keep it, that's a tough deal. Those are very, very high risk, stocks, just like back in the dot-com days. Now, I'm not telling you not to buy NVIDIA. In fact, NVIDIA, just to give you an example, I'm going to pop it up here. NVIDIA is in good shape from the point of view it's above all its supports. That's good news. The bad news is, NVIDIA, we don't have a strong money trend. What's that mean? Well, a lot of that move from August 3rd to today is short covering. How do you know that? It's not new money going in. Well, if you switch your chart, okay, to a line chart, it's very clear. I mean, it's a straight line. going up from around I think it's around 188, 190, straight up to 241. That's not new money. Most of that money is the same people who sold it short. They have to buy it back. So most of the buying in NVIDIA was at $221 today. It wasn't at one. What am I going to say here? 182 or 192. Wasn't it 196? Not even 200. They went in right where the emotion is. That's the problem when you're chasing these big tech stocks like this. It's all emotion. You got all these tourists jumping in that don't know what they're doing, and it just sets up for a big failure. So again, this is not the time to buy NVIDIA. And if I was in NVIDIA right now, I wouldn't get out of it totally, no way. But I certainly would be selling into this big rally that we had from $188 up to 221. What percentage is that, Stephen or Willie? 188 to 221. I mean, that's a 17.5% gain. If you're not selling into that, and we're in a situation right now, okay, that as long as yields are down, you're going to have some security, but the minute the yields turn around and start going back up, there'll be a big dump in that stock. Everybody will start dumping it. Because again, we're not seeing a lot of new money coming in. We're not seeing the institutional money coming in. The machines are coming in and buying the stock, not the institutions. You got to understand the difference. These are trading programs. They took the place of the institutions because the institutions are sitting on the sideline because they don't like the way the bond market looks right now. They don't like the yields, bond yields right now. It's too volatile. So you have machines who have been programmed, and what they do is they move these stocks back up so fast, and then what happens? They'll fade them. They'll turn around and fade them. They won't support where it is. So if you got in the stock at, let's say, 204, it's up 221, you should take a lot of that profit. Don't think, I'm going to hold on, it's going to keep going up. But most people didn't get in there. Most people got in today, and they're going to get crushed. You got to wait till it pulls back. Let it pull back and only buy it if you want a risk-off trade with NVIDIA. Buy it when the stock pulls back, and when it starts going back up, as long as there's a lot of volume, and as long as the yields are going down. Never buy that stock with yields going up. You got to have that yield going down, all right? Or otherwise you get crushed. So, again, we are seeing right now, the expectations, for evaluations and for NVIDIA is so high. It's unbelievable. And it's just a big risk, that's all. I don't want to discourage you, but I've been through all this and I've seen it before. And sometimes you just want to get a nice, steady stock that is always trading with its compass. What's that mean? Well, a yield, your 2-year and your 10-year treasury yield is like a compass. It always will tell you the truth, which direction your stock is going to go. When you go buy a stock and you look at the yield, it's like a compass. It will point which direction that stock will go. And it will let you know, even before the market knows, the direction is going to go or if it's going to change. And as long as you're up on your yields, you understand them, yeah, go ahead and buy any tech stock. But also have the skill to short too. But there's so many, there's a lot of rotation, by the way, out of tech stocks right now, and they're going into the economy stocks. And we're talking about that today. Now, the economy stocks, for example, they're pulling out of all these. I don't mean they're dumping it and just running. I'm not saying that at all. I'm saying the smart money is rotating money out of a lot of these tech stocks, and they're going to the economy stocks. Now, what am I talking about? Well, let's take, for example, bank stocks. Now the bank stocks, these stocks have been doing terrific. Now there's a problem with the bank stocks. Okay, now we bought for our gang. Bring some milk home. Okay, we bought for our gang Bank of America. That was around June 4th. June 4th, June 5, June 6, right in there, when it was around $54. And today it's up nice around $63. Now, the problem with the stock, all along the bank stocks, the compass is telling you, the yields, which is the compass, is telling you these stocks shouldn't be going up. That means the yields are going the wrong direction. Yields are going down, which is like a compass telling you that the stock will come down. But in the meantime, what's happening is the big institutions, when I say who are the big institutions, BlackRock, Vanguard, State Street, Fidelity, T. Rowe Price, Capital Group, they control $50 to $60 trillion, which they always have $10 to $12 trillion in the market. They control that money. And for now, they're pouring money into these bank stocks, taking money out of tech, putting them into the bank stocks, and that's okay to be in these bank stocks. But the first thing you should check is, wait a minute, what is the yield doing? And if the yield is going down, and the tech stock is going, and the bank stocks are going up, that's just a warning. It doesn't mean, it just means it's a risk-on trade. If the yields were going up, then it's a risk-off trade. So anytime you trade a stock, before you trade it, find out if it's risk-on or risk-off. Now, it doesn't mean you can't trade a stock that's risk-on. We're in Bank of America. We're in JP Morgan, and it's risk-on, but at least I know that. If you take 65 million people, tourist traders, we call them, only 5% of the 65 million know that. But every time you trade, as long as you know, is it risk on or risk off, man, you're 3/4 home. And more people because again, you can have a risk on stock, but Wall Street will say, you know what, we want to push for our teachers union, we want to push for the corporate pensions, we want to push for the sovereign wealth funds we manage, we want to push these bank stocks. So they got enough firepower, enough money to push these stocks up, even though the compass is telling you, okay, the yields are telling you that it's a big risk on stock. All you have to do is, when it's a risk on stock, just manage the risk, that's all. But you can't manage the risk unless you know it's a risk on stock. And it's the same thing with NVDA. Okay, you got any stock you're in, especially these high flyers, always know if they're risk on or risk off. You still can buy when they're risk on, identify it, but just know that, then you'll manage that risk. Otherwise, that's where people get these big surprises. They jump at a stock, they have no idea it's risk on, they're in for a week or so, then all of a sudden it collapses. Well, that won't happen to you if you understand risk on, risk off, and you do that with yields. We'll show you how to do it. That's about it, okay? I know talking about stocks like watching paint dry, but I'm not going to talk about Hormuz or the Strait. I'm not going to talk about that. Okay, I will see you tomorrow, same place, same time. Be careful when you're trading. Stocks always do what they're supposed to do, but never when they're supposed to do it. So know how to short and know how to read your charts, okay? See you on the charts.
Nuts.